Hey everyone, so have you ever wondered how to be a contrarian investor? As an actuary, a mathematician, and an investment researcher with over 10 years experience, I've seen my fair share of investment strategies. Today, I wanted to talk through contrarian investing, which is one of my favorites. So let's get into it. So contrarian investing is essentially investing against the crowd, and this is something I've always had a bit of an affinity with and I kind of like not being a sheep or following the herd. So this is something that's quite close to my heart, and it's something I've implemented a lot at work. So today I wanted to talk through 3 elements of contrarian investing and what to expect if you decide to go down this route. Element number 1 of contrarian investing is that you have to love to lose. And that's a really interesting point, I think, when you're thinking about investing, because I think most people get into investing thinking that they want to make loads of money, not they've got to love to lose. And also because of loss aversion, which is mentioned in Thinking Fast and Slow, people generally hate to lose. So you've got to love to lose to be a contrarian investor. And I got that from Mark Spitznagel, and he wrote this book called The Tao of Capital, which I thought was a bit of a weird title, but I absolutely loved it. And he talks about how you've got to love to lose was the first bit of advice he got when he started on the trading floor in Chicago, and has actually taken that through his career. And now he runs a successful tail hedge fund focusing on making money when markets crash. And the reason why he has this advice, you've got to love to lose, is because when you're a trader, the worst thing is having a loss that you can't recover from. So you've got to be very quick to take your losses when you're trading, and that's kind of trading 101. On the flip side, if you generate a big profit, the idea is you let that run. And this is an idea based on the gambler's ruin problem, saying that if you actually have a probability of ruin and you keep taking that bet, then at some point you must eventually ruin. So the idea is to avoid ruin. And there's a mathematical formula surrounding that called the Kelly Criterion, which talks about how you should size your bets based on your risk reward to make sure you avoid ruin. And that is talked about quite in depth in Manful Markets by Edward Thorpe, who obviously applied the Kelly Criterion first in gambling and then in the markets. This is a really fascinating book. Ed Thorpe was actually one of the first people who discovered the option pricing formula before Black-Scholes, who later formalized it, and he talks about how he first started to build gambling systems, so blackjack, and eventually tried to beat roulette. And he talks about how the Kelly Criterion gives him the optimal betting size. So you've got to love to lose. And the other reason why when you're a contrarian investor you've got to love to lose is because you're probably going to lose a lot, because by the nature of being a contrarian, what you think is going to happen isn't going to happen most of the time. So you have to be prepared to weather that kind of emotional storm, I would say. And I definitely experienced this at work, because part of my role was putting on tail hedges and dealing with macro managers that had optionality. Therefore, when things weren't happening or when there was low market volatility, these strategies were bleeding capital. And I had to deal with lots of questions from people saying, why are we invested in these? Why is it bleeding money? Why is it losing money all the time? And I wish at the time I'd known the phrase, you've got to love to lose, to benefit from those massive gains if you're a contrarian. So I would say that VC, venture capital investing, is a form of contrarian investing, because you've got to find those companies that no one thinks are going to succeed, or you've got to see that needle in the haystack. But my favorite form of contrarian investing is using tail hedging, so option strategies, and that's just because of my mathematical background and my love of derivatives and financial maths. So Mark Spitznagel, who wrote the book The Tao of Capital, he actually runs a hedge fund, and if you look at the return profile of that hedge fund, it's very much a slow bleed down, so he's got to love to lose. So element number 2 is that you can generate enormous gains. So think of the VC investor that picks the next Google or Amazon, or think of the film The Big Short, where the characters profit hugely from the financial crisis because they saw it coming when no one else did. So one of the benefits of being a contrarian investor is that you can generate huge outside performance if you're prepared to love to lose and stay in the game long enough. I spoke about The Big Short, and they obviously profited from the Black Swan, which was the financial crisis, and obviously Nassim Taleb has written extensively about tail risks and how these outsized events occur more often than you think in his book The Black Swan. So I'd thoroughly recommend that. It's absolutely fascinating, and definitely for me, coming from a background of traditional financial maths, so focused on like normal distributions, his summary on why that has issues and his discussion of the alternative is actually really fascinating, and I definitely love this book. And then the reason why you can profit hugely from these massive outside tail risks is because of something known as convexity, and option contracts typically have convexity. So for those of you that don't know, an option gives you the right but not the obligation to purchase a security at a certain price at a certain point in time. An integral characteristic to the option, or a call option in particular, is that it has a convex payoff. So basically it starts increasing quite slowly, and then it increases almost exponentially towards the end. And this is something that can help you generate huge returns because your profit function versus the price of the underlying is a exponential curve. So basically, the more right you are, the faster your profits increase. And this is why using options, you can generate huge outperformance, which often makes up for the years where you've lost money paying for your option premiums. And that's discussed quite extensively in Nassim Taleb's follow-up book, Anti-Fragile, where he talks about things that gain from disorder. So tail hedges and option contracts typically gain from increases in volatility. And there are lots of examples here of that convex payoff. Note that in order to generate this kind of profit, you have to spot something that no one else has, hence the contrarian aspect. So it was common knowledge, the thing that you were betting on, then it would be already in the price. So the price of option contracts in the middle of the pandemic and the financial crisis were obviously pricing in the huge increase in volatility. So if you got in ahead of that, then you would have benefited from the explosive gains. So point 3 about contrarian investing is that you can't really time the payoff function, but if you're betting on a financial crisis, the payoff really matters. So one of the benefits of contrarian investing via tail hedging is that your tail hedge pays off immediately when the financial market crashes. And what that means is that you get this big payout of capital precisely when stocks are at their cheapest. So you can reinvest that capital and hopefully generate outside performance as a result. And this is an idea called time-dependent diversification. So instead of looking at your returns over the course of a year, you can look at your time-dependent diversification, so what's performing at any one point versus something else. And tail hedging gives you certain payoffs in big equity market drawdowns, provided it's constructed right. Problem with this is it takes huge bravery, because typically when your tail hedge is paying off, the world is, imploding. You gotta be quite brave to put that money straight back to work. I remember in the pandemic, what happened was obviously the Federal Reserve came in and started buying securities to help prop up the market. The equity market eventually started to rebound. So if you were able to get in at the right time, you could generate huge performance. But as Howard Marks says, you might want to actually perhaps not participate in the first turnaround, just because it could be very scary, and also you might not be sure it's the bottom of the trough. One of the common things about contrarian investing is that you can't really time it, but the timing kind of matters because you get your capital when you most need it in tail hedging. I think with VC, obviously you can't really time when your idea is going to take off, but that kind of reiterates the importance of staying the course. So there we have it. That's my discussion of one of my favorite forms of investing, contrarian investing, particularly through investing in tail hedging and option strategies. If you enjoyed this video, don't forget to check out this one here from me.